China is leveraging its domination of rare earth metal supply chains to put pressure on the United States in trade negotiations. Their most recent move in April 2025 was to require export licensing for 7 rare earth metals required to produce battery magnets and other crucial applications. This is on top of other previous bans on various metal exports to the United States. All of these efforts effectively halt or slow down the supply of these critical materials to the country. In this video, we will cover the effects of these bans and how we as investors can benefit from this trade war by investing in sources of rare earth metals outside of China, miners or processing companies. First, we should go over all the different rare earth metals, what they are, and why they're so important. So you can see the list of 17 various rare earth metals in this list on the screen. They're used to create a variety of different crucial products. Aerospace components, superconductors, batteries, magnets, nuclear reactor control rods. It's obvious why we need these materials. You can pause the video to see them all. While rare earth minerals are actually found all over the earth, the problem is that it's difficult to find them in concentrated areas in large enough quantities to justify creating a mine. There is a significant lack of economic mineral deposits outside of China. More and more potential sources are emerging as we start exploring for these metals. That's something we'll discuss later in the video as we go over potential investment options. But the United States and the entirety of the Western world has put themselves in a bad position by letting China dominate the supply chain for these critical metals. China accounts for approximately 70% of the rare earth metal imports to the United States. So China can leverage that control to essentially make the United States do what it wants. If China entirely bans the export of these minerals, then the price of these metals increases drastically. For example, in 2024, China put export licensing requirements in place on antimony, which is used for flame retardants, machine bearings, and electronics, among other applications. That immediately shot the price of antimony up from $14,000 per metric ton to $56,000 over the span of a single year. So we're looking at dramatic price increases for any material that has disruptions like this, which benefits any of the miners outside of China that can supply some material to help bridge the gap. Although it won't be enough. Not only does China control approximately 60 to 70% of the global mineral production, but they also control an even larger percentage, if not the entirety, of the refining and processing stages of the supply chain. Mining the minerals is one thing, but it's a whole other story when it comes to figuring out how to refine and process those materials into batteries or magnets, etc. Back in 2023, China also announced a ban on exporting the technology to refine and process rare earths in other countries. They are keen on maintaining this advantage and leveraging it to threaten Western nations. So investing in companies capable of refining and separating these metals would be even more valuable than the mines themselves, considering just how rare that is outside of China. Refining and separating rare earths can be a challenging process. Since there are often a variety of different metals in these deposits, when you mine the ore, you're essentially just getting a concentrate of a variety of metals. You have to separate them through different treatment processes, at which point you can refine them further to reach the purity you need to actually use them for the production of magnets or other products. Many of the use cases are for products relevant to national security and military applications. China even directly targeted around 45 different companies for specified export restrictions because many of the companies provide crucial services or products for the United States military. At this point, those targeted restrictions on certain companies have been suspended as a part of ongoing negotiations, but it shows you how China is being precise in the ways it punishes the United States and the Trump administration due to the tariff situation. Things are starting to move along here in June as some of the major US automakers are being given temporary export licenses to avoid any further supply chain disruptions. That's one of the major industries that could be in trouble if these rare earth export restrictions last for too long. Electric vehicle batteries and other car parts rely on these rare earth metals. General Motors, Ford, and Stellantis are being given reprieve for now. The specifics are relatively unknown, which tends to be the norm in these negotiations, unfortunately. Earlier last week, it seemed like Trump and President Xi of China were at an impasse and trade negotiations were stalling, but now they've scheduled meetings for further talks in London, which are currently ongoing, particularly around policy surrounding rare earths. So this sector is at the center of the discussions taking place right now. And Trump has even recently said that Xi has agreed to let rare earth metal exports and magnets flow. In typical Trump fashion, we don't know how credible that really is. But assuming that's true, does that mean that it's not worth it to invest in rare earth metals anymore? I would say that it can still be interesting, because as we laid out earlier, It's in the best interest of the United States and other countries to try to get as many alternative sources of rare earths online as possible, as fast as possible. My assumption would be that the Trump administration and the Chinese reach a deal, and that is often what tends to happen. Everyone gets anxious, and then the situation ends up getting resolved one way or another. The global economy is so intertwined that China gets hurt as well, even when wielding this power over us. So there's an obvious need to reduce our reliance on China, and Trump is continually hawkish on the supply chain and advocating for domestic sources of these materials. There are shortages of various different commodities, and new trade disputes with China can emerge at any time. All of these different factors are ultimately positive developments for any company with exposure to rare earths outside of China. So let's review the potential investment options that we have to choose from. And for this video, we're focusing on ETF options or mining and processing companies that are projected to begin producing rare earth metals within the next 1 to 2 years, if not already. In my experience and what most mining investors will tell you, we generally are going to want to invest in companies that can actually take advantage of recent price increases and will not endlessly dilute shareholders. The process of building a new mine can be extremely expensive and time consuming. So unless you want to be a speculator, it's best to buy companies close to production and already past the exploration stage. The Lassonde curve is a perfect depiction of this. Exploration companies are risky, so focusing on companies that are close to actually producing and starting a mine is best, albeit these are still generally risky companies to invest in, and you should always do your own research to know what you're getting yourself into. Now with that said, let's start with the ETF and then go over the miners. Now, the only real ETF that offers any specific exposure to rare earths is the VanEck Rare Earth and Strategic Metals ETF, ticker REMX. The ETF has a net asset value of around $260 million and has not been performing very well, to be frank. I assume that's because both the Chinese stock market and lithium companies and some of the other metals have not done well over the last few years. If you take a look at the top holdings of the ETF, it includes some rare earth companies near the top like CNRET, Lynas Rare Earths, MP Materials. These companies are focused on rare earths, but many of the other companies like Albemarle, SQM, Pilbara, and others, these are large lithium miners, titanium, tungsten, etc. There's a variety of different metals here that you're getting exposure to with this ETF, not just rare earths. It's so diversified, it's difficult to see how owning this ETF is better than just investing in the individual companies, unless you want exposure to Chinese firms as well, since it's hard to invest in them overseas. If owning a variety of different critical metals, along with different Chinese firms, sounds interesting to you, then you might like that ETF, but I assume you probably want to hear more about the potential mining options that you can invest in. So let's move on to that. MP Materials is the first mining stock that we'll cover, ticker MP. Has a market cap of around $4 billion. This company stands as the largest producer of rare earth metals in the Western Hemisphere, operating the historic Mountain Pass mine and processing facility in California, as well as building a magnet manufacturing facility in Texas. So they're creating a vertically integrated supply chain to supply critical magnets to the electric vehicle and renewable energy industries and so on. They're in the process of ramping up both their mining operations and the magnet facility, with deliveries of magnets anticipated by the end of 2025. And because the United States knows it's messed up by letting China dominate these supply chains, the US is incentivized to support these projects, which is why the government has provided some funding and tax credits, among other subsidies and benefits, to MP Materials and a few other companies, including the second stock on our list, Lynas Rare Earths, which is ticker LYC on the Australian Stock Exchange. It also trades on the OTC Pink Sheets. With a market cap of $8.5 billion, Lynas is the largest producer of rare earth metals outside of China. They have the Mount Weld mine and concentrator in Western Australia, additional processing facilities in Malaysia and Australia, and Lynas is also building new processing and separation facilities in Texas, which is a $3.2 billion investment that's targeting initial processing in 2026. The United States has provided nearly $300 million in funding to support establishing a rare earth supply chain domestically. That is a relatively small portion of the funding of the $3.2 billion, but it's proof that we've identified the problem and the government is willing to provide some funding through the Defense Production Act, the Bipartisan Infrastructure Law, and the Inflation Reduction Act. So MP Materials and Lynas Rare Earths are your two major producers outside of China if you want to buy an established player. Energy Fuels, ticker UUUU, is the third stock on our list. They have a market cap of around $1 billion. And this company is actually primarily in the uranium business, but they are using an older mill they acquired to process and separate rare earth metals. That mill is in Utah, and they now have several potential rare earth projects in Brazil, Madagascar, and Australia that could provide feedstock for the mill later on. The Donald project in Australia, which is a joint venture, is expected to commence production as early as 2026, so that would provide immediate feedstock for energy fuels that they own themselves, providing additional revenue. So if you want uranium exposure and to get in on the rare earths trend, this could be a decent option. Company number 4 is Iluka Resources, ticker ILKAY on the OTC and ILU in Australia. Market cap of $1 billion. This is an already established mineral sand producer, primarily zircon and titanium. They are diversifying into rare earth refining through financial backing from the Australian government. Iluka has received an approximate $1.6 billion loan from the Australian government's critical minerals facility to build a rare earth refinery in Western Australia. It's still under construction and expected to be commissioned in 2026, with first rare earth separation and refinement to occur in 2027. Additionally, the Balranald project in New South Wales should produce mineral sands that will contain rare earth-bearing minerals. So that will provide additional feedstock for the refinery, and that should be completed first in the second half of this year. So Iluka's another company that is diversifying from another industry to enter the rare earth space. Moving on to company number 5, we have USA Rare Earth, ticker USAR on the Nasdaq. This stock also has a market cap of $1 billion, and the company owns 80% of a large rare earth deposit in Texas and is currently in the process of developing a magnet facility with the first production line set to start up in 2026. My understanding is that the rare earth deposit, the Round Top Mountain, already begun production of rare earths, and it confirmed successful mining operations. So that's another vertically integrated player building out production in the United States. Arafura Rare Earths is up next, ticker ARU on the ASX, market cap of $430 million. Another mining company in Australia operating the Nolans project in the Northern Territory of the country. Arafura wants to build a mine, a benediction plant, extraction, and separation plants all in one location. So the goal is to have most of the steps required to create separated metals on site. The timeline on this one's a little iffy, but they might get their mining completed in 2027 or 2028, depending on receiving additional financing to start construction. But the project is all ready to go with all of its mining permits and some offtake agreements in place, and they just need that financing. With a price tag of nearly $1.6 billion, they still need to figure out how to get their hands on an additional $600 to $700 million from the looks of it. Hastings Technology Metals, ticker HAS on the ASX, is up next. Market cap of $55 million, so this is one of the smallest companies on our stock list. This is another mining company with 40% ownership of the Yangibana project in Western Australia. They've entered this joint venture with Wyloo Metals, which is an established miner of nickel and other natural resources. So Hastings has an advanced partner on the project to produce its first metal later this year, with plans for further refining capabilities to create mixed rare earth carbonate by 2026. While Hastings traded away its majority ownership stake in the project to Wyloo, they brought in an experienced partner that should make the project far more likely to succeed, which is a big deal in the mining space. Pensana's up. They are developing a rare earth deposit in Angola and a rare earth separation project in the United Kingdom. They have a market cap of $160 million, ticker PRE on the London Stock Exchange. They've started construction of the rare earth project in Angola, with initial estimates being that first rare earth metal production will start late 2026. No timeline for the separation facility is available yet, and that will be waiting until Angola is operational, so that's another developer to look into. Moving on to VHM, with the ticker VHM on the ASX, market cap of $60 million. This is another company that will offer exposure to rare earth mineral sands when their project is online. The Goshen project in Victoria, Australia. That timeline puts first production in Q4 2026, with a staged ramp up to later reach 5 metric tons per annum. Ionic Rare Earths, ticker IXR on the ASX, has a market cap of $36 million. They have a rare earths project in Uganda that's currently undergoing negotiations to find off-takers that could accelerate the project's development. There was already a demonstration plant that was created on site and successfully produced mixed rare earths back in March 2024. So they're mainly waiting to see when they can reach a final investment decision to start building the project upon receiving adequate financing. Ionic also has a recycling facility that's in the works in Belfast, which could recycle its first magnets by early 2027 if construction commences soon. Neo Performance Metals has the ticker NEO on the TSX with an approximate $480 million market cap. This one's a little more diversified as they produce different products primarily for the automotive industry, but they have significant exposure to the rare earth supply chain through the only operational rare earth separation plant in Europe, which is located in Estonia. Additionally, they are also constructing a magnet facility in the same country, which is slated to create enough magnets to supply around 1.5 million electric vehicles in 2026. The company's already delivered 18,000 magnet pieces to a Tier 1 customer in April 2025, so they have proven initial production was successful. So if you want a company that will likely play a vital role in the rare earth supply chain, but does not carry the risk of developing mining projects, then NEO might be what you're looking for. Now, ultimately, which stock or group of stocks you might choose to invest in here depends on what your goals are. If you want just safe and proven producers, then you'd go with MP Materials or Lynas Rare Earths. If you just want exposure to the separation and refining process, then you could go for Energy Fuels or Neo Performance Metals. If you're looking for potential buyout targets, then the Chinese mining companies like to buy mines outside of countries like Australia or the United States. They want more neutral countries. So you could be interested in the few mines in places like Africa with Pensana or Ionic rare earths. It's really up to you how you would choose to play it, but I'm here to provide a list of companies that are projected to at least be close to producing metal and generating revenues relatively soon. Another important factor to keep in mind is which metals these companies are producing, because each individual market can have different supply and demand fundamentals. I could not really go over that in depth in this video since it was already pretty long, but I would recommend researching those specifics as well when buying any of these stocks. And I'll mention a warning that mining companies commonly run into issues when developing new mines. They run over budget, the rock can be tougher to mine than anticipated, natural disasters, the list is endless. So by no means are any of these companies safe investments. And you should conduct thorough research before buying any of them, and this is really just a list for you to research further. So with that said, if you'd like to stay up to date about these significant market-moving events like this, and learn about different potential investment options to take advantage of them, then subscribe to this YouTube channel and check out my Substack, links in the description. Thanks for watching.